I worked on a property in 2009, and there was an 81-unit building on MacArthur. And I was going to the property to deliver notices for the tenants. We're getting ready to do a walkthrough. And there was a quadruple homicide. And it was the police who just got killed. So the whole block was taped off. There was literally bloods on the street. It was crazy. My client almost backed out of that deal, but he didn't. He bought it. He bought that. It was 81 units. He bought it for $3.7 million. He just refinanced that place a little while ago for 4.2. And he got like a 3.75% interest rate, 30-year loan, Fannie Mae. So it was worth 7.5. This is a little while ago. So he made a good move, right? But at that time, real estate wasn't popular. We didn't know what was going to happen. So I was a little bit crazy, but I thought it was a good time to start a company because I did see some opportunity because I'd never seen prices in the Bay Area hit that rock bottom. You know what I mean? It was rock bottom. It's like the prices just literally jumped off a cliff, right? Because I started in real estate in 2003. And so the first property I sold was my mother's house, tough part of East Oakland. It was for $325 grand in 2005. The termites were literally holding the building up, right? But it sold, and it sold quick. And I remember that period of time as like, how is this possible? And it wasn't possible. It was more than anything, it was funny money. It wasn't real. It was inflated. So when it crashed, I saw an opportunity because people need to live somewhere, right? And in this complex technological society that we lived in, everything is integrated and everything affects everything. If a company goes out of business in China, it affects us over here, and vice versa, in Europe, and all that stuff, right? But when things got crazy, what I was looking for is simplicity, and I found that in real estate, and specifically, I found that in apartment buildings. So that's why I broke off from my old brokerage, started the firm, took a big risk, had to sweat it out for a couple years. But as the market improved and we improved as a company, we began to build. And we started doing this seminar a couple years ago because I really thought it was important to educate people on some of the fundamentals of how to be successful in real estate. So I saw simplicity within real estate. I saw that there was a huge opportunity. And if anybody read the book From Good to Great, written by Jim Collins, it's a really good book. If you're into business, if you're into just success concepts, it's a really good book. But he talks about the fox and the hedgehog. The fox is a really cunning creature. It's got a lot of different strategies, really smart, kind of the jack of all trades. Whereas the hedgehog is a pudgy, dowdy kind of a creature. There's nothing special about him. Doesn't have any real skills other than one. He's got one really good skill. When he gets attacked, he just curls up in a ball and nobody can pierce his skin. So when the fox comes up with a million different strategies of how to kill this hedgehog and eat him, he's never successful no matter how complex his strategy is because he can't beat the one strategy that the hedgehog has mastered. The fox is a jack of all trades. The hedgehog is a master in defense. So the fox never beats the hedgehog because the hedgehog is singularly focused into his one strategy that he's better than anything else in the world. And so Jim Collins in his book, he talks about companies that are focused on what he calls the hedgehog concept, and that's what's kind of led them to success. It's a really good book. I highly recommend it. But I saw that in real estate. I saw that the guys that made millions of dollars, some of my clients that have made millions of dollars, have focused in singularly on the fundamentals and have mastered them and made millions of dollars. Whereas, like in the old economy, there was all these exotic, complex financial instruments, right? What do they call it? What did they used to call it? Stated income? Right, heard of that? Stated income, 100% financing. In commercial, there's all these high loan-to-value, mezzanine-type loans. Well, what happened in the old market is we got away from the fundamentals. So what I do in these seminars and what I try to do in my practice is focus in on the fundamentals, master them, teach them, practice them. So what I'm going to talk about in my presentation is the basic fundamentals of how to analyze an investment. What makes an investment property good, what makes it not good, how do you get to that point. And then what I'm going to do towards the end of the presentation is I'm going to talk about rate of return versus return on equity. Okay, as the market has come up, as it has pretty significantly over a couple of years, you got some equity in your property, you're trying to figure out what do I do. There's a couple key factors to consider when you're thinking about selling, when you're thinking about holding, and you're developing your investment plan. That make sense? Yeah. All right. That being said, let's just talk about some basic real estate food groups. When I tell people I'm involved in the real estate business, instantly they think, well, I'm looking at buying a house, which is great. That's a good thing to think about, right? A single family home is one aspect of the real estate food group, right? We got townhouses, condos, 2 to 4 unit, we call residential income. 5+ unit, we call it multifamily commercial. Retail property, that's the property you're sitting in. This is a retail property. Office property, industrial property. Industrial property, that's going to be warehouses, R&D, R&D is research and development. Hospitality, that's going to be, hotels, motels. The list goes on and on. These are the top real estate food groups, okay? We focus, we work on multifamily properties. Thank you, sorry about that. Well, I'm glad he came in here. I'm glad he came in to talk to us. So these are the main food groups. I focus in on multifamily, okay? That's my sweet spot. Doesn't mean I don't do other product types. Like I bought this property, right? It's retail. Done single family flips. But my sweet spot, what I love, what I teach and preach is multifamily properties. Why is that? Well, a couple things. Stable cash flow during the holding period. So holding period is when you own the property, right? I say that having seen the good, the bad, and the ugly over the last 12 years in real estate. When the market crashed, right, in 2009, prices dropped 70% in some markets, 80% in some markets, right? But vacancy rates, they didn't drop 70%. They maybe dropped about 5-10% in the Bay Area. Stockton, Sacramento, maybe 10-15%. They didn't drop off 70%. Why is that? Anybody got an idea? Why is that? People need a place. It's not complex. It's not rocket science. You get foreclosed on. You lose your house. That sucks. It's not a cool thing. But you know what? You're resilient. You got a family. You're not just going to get. Well, most people. You're not just going to come out here to the 24th and Telegraph and roll up on the sidewalk and say, hey, here's where I'm at, right? You need some shelter. It's a couple of people out there. That's what I'm going to say. It's not everybody. But what I'm saying is it's a necessity, right? It's not something that is an exotic program that was just here today, going tomorrow. It's an absolute necessity. So when the market went bad, people needed a place to live. Their credit was screwed, but they needed a place to live. So in the worst of times, the vacancy rate didn't drop at the rate of prices, Neither did rent rates. Rental rates only dropped about 10-15%. So there was stability during the cash flow, even in the worst possible economic times. All right? And that's why I say high occupancy rates historically and currently. Currently, in a good environment, forget about it. Anybody pay attention to any of the Marcus and Millitrap reports? I know that might be foreign to you guys, but Marcus and Millitrap is probably the top apartment brokerage in the country. They just came out with their 2015 apartment market report. Guess who's got the lowest vacancy rate in the country? Guess. Major city. Oakland has the lowest vacancy rate in front of San Francisco, in front of New York City. Who would have thought that, right? Who would have thought it?
Oakland in front of the city?
Oakland more than the city. More than New York City. Now, here's the deal. Part of that's because we don't have 1 million skyscrapers, right? We don't have 1 million buildings yet. But we got a huge amount of demand. So now, I could forget about it. Holly, we were just talking about rents.
You are in a great space, too, because Google just bought a building out here.
Sears. Yeah.
Yes,
Sears building.
So they're going to be making their way up to buy up people.
Well, no, absolutely. And they're coming right down the street, as you can walk down there. So this is a hot spot, you guys. But even in places like Stockton, which is, nothing bad about Stockton, but they got hit hard. Now, their vacancy rate is back to under 10%. Their rents have shot back up. Their prices have shot back up. That's why I like multifamily property. Also, it's a great generator of wealth, and it's a great preserver of wealth. So in other words, if you're looking on, hey, how do I come up in the world? How do I live the American dream? It's a great way to leverage yourself. Anybody play Monopoly? What is the formula? 4 green houses, 1 red hotel. Did I say that right? Right? So apartments allow you to do that. It gives you a leverage. You know, if you got 10 units, somebody moves out, you still got 9 units paying you, right? You got a ton of money, you're sitting on a bunch of money, and you're sitting here saying, well, I don't want to lose this money. I'm just looking to beat inflation, all right? I'm looking to, not pay a bunch of taxes. Well, then that's why you buy property in San Francisco. And that's why people say, well, how do these people buy these properties in San Francisco for these crazy prices? That doesn't make any sense. They're stupid. Not necessarily, because they got a lot of cash and they got to do something with it, right? What better market would you have your money than in San Francisco, right? So that it's a great generator of wealth. It's a great preserver of wealth. It does both, right? Okay, so within that, there's some key indicators that we look at when we're evaluating property, all right? First one is the cash flow. I know that sounds simple, and every real estate book you read should say cash flow, cash flow, cash flow. Right? Even in the Bay Area, right, where prices are crazy, you still want to look at cash flow. That percentage may be low, but the property should cash flow versus being negative. Big problem in the old market, you guys. People bought property saying, I'm not worried about losing money. It's okay, I'm making 200 grand in my job. It's gonna go up, it's gonna go up, it's gonna go up. Did you hear anybody say that? Right? Sometimes it goes up, sometimes it goes down. What allows you to win in the worst periods of time is if you have cash flow, all right? It's real simple. In order to get the cash flow, we look at what's called the NOI details. NOI is net operating income, and the details surrounding that. That helps us to evaluate a property. Also, obviously, we look at the price as it relates to the cap rate. Cap rate stands for capitalization rate. I'll go into that. Return on investment and return on equity. This is not something you hear so much in real estate. You may hear it more in the stock world, return on equity, stockholders' equity, but it's just something that you need to look at if you own property. Return on equity doesn't mean anything to you if you don't own property yet, but if you own property, you got to look at that return on equity and what does that mean in your portfolio? What does it mean in your bottom line? All right? And then the last one is cash on cash return. That's the actual cash you're generating from the cash you put out. All right? Simple things, but easy to get lost in the sauce. All right? So I'm going to blast that over real quick how we analyze a building, whether it's a house for income that we're buying, if you're buying a house to rent it out, or you're buying a 100-unit, or you're buying a skyscraper. This is the stuff you want to look at, right? And you want to master it. You want to drill it. You want to practice. I guarantee you the Seahawks and the Patriots right now, everything they're doing in their practice, they've probably done 1,000 times this year, right? So coaches are going to say, all right, we did this 1,000 times. Tom Brady already got 3 Super Bowls. Go sit on the sidelines and we'll see the Seahawks on Sunday. No, right? They're drilling this stuff every single day, every finite detail. Hopefully they're not deflating balls, but you know what I'm saying? Every finite detail, that's what they're getting ready for this game, and they're going through it. You got to do the same. You got to do the same, right? So when we're looking at a building, first thing we got to do is we got to start with the top line item. That's our rents and what's called the gross scheduled rent. And you're going to get this number from what's called the rent roll. And I'll talk a little bit about that. The rent roll is going to tell you who's in the building, how much they're paying, when they moved in, when they moved out. And that's either for an apartment building, same thing for an office building, same thing for a retail strip center. So you get your gross scheduled rents, and then you start taking away from that, all right? You take away vacancy, all right? Key thing to understand, within a building itself has a vacancy rate. A market also has a vacancy rate, right? So you may be looking at a building, perfect example. I'll talk about, at the end of my talk, a couple off-market apartment buildings I'm working on. But there's one that it's an 18-unit building, 7 units are vacant, right? That's terrible, especially in this market where you got like a 2.5% vacancy rate, right? So understand what the building's vacancy rate is versus the market vacancy rate. And you can figure out what the market vacancy rate is. You can go to marketsandmillerchop.com, Berkadia.com, and a bunch of other websites. If you just Google vacancy rate, I'm sure 10 of them will pop up. I recommend Marcus and Miller Chap, even though it's like a direct competitor, but they got some great research and it's free. Hit up their website and you can see each major metropolitan area in the States. And I even think they added Vancouver. I think they did add Vancouver and Toronto. And I think one more MSA in Canada. They'll tell you the vacancy rate, the rent rate, the price per unit rate, all these fabulous details you can get on a market. So research, know the vacancy rate of the building, know the vacancy rate of the market. Then from that, you take away something called loss to lease concessions. This is a forgotten number. This is when people don't pay their rent. This is when people, when you lease out units, sometimes if the rental market's soft, you may have to give away concessions, first month free. Come on in. First month free, no deposit. Right now, nobody's doing that. Nobody's doing that right now. However, a few years ago, first month free was pretty common. A $99 deposit was pretty common. So it depends on the market. Factor that into what you're doing. Factor that into your analysis. Now, when you take away from the income with vacancy and loss to lease, you have to add to it what's called other income. This is also an opportunity if you see a building that does not have other income, but could have other income. Other income is what? Laundry machines. A lot of apartment buildings, if you got a 4-unit apartment building and above, there should be some type of on-site laundry. If it's a big enough apartment building, it should be vending. And also there should be billboard, well, there not should be, but there may be billboards on the property. These are other ways of generating income that are not rental income. If you have a property that doesn't have it now, look for ways that you can generate income. If a property is big enough also, you can get a contract with like Comcast, or I think some of the satellite companies, but Comcast for sure. If you have a 90-unit building, you sign a contract with Comcast. Everybody in that building who signs up for Comcast, you get a like a royalty for it. It's like a $10 or $15 royalty. Not that much in and of itself, but it adds up. And I'll show you how it directly affects the value of the property. So look for other income. So your gross rents, gross scheduled rents minus vacancy, loss to lease, added to that other income, that gets you your effective gross. That's the real money you brought in monthly. It's the real money you brought in annually. Uh-oh. Sorry. Now, so now you got, this is the hard dollars you brought in, right? Now from that, you got to take away operating expenses, all right? This is where a lot of people miss the boat. So don't miss the boat if you're looking at properties on this. And again, whether it's a house or it's a 100-unit, to the finite detail, you want to understand this. Believe me, I know I've missed finite details before, and they always pop up at the wrong time. That's just what they do. Finite details always pop at the wrong time. So try to evaluate as much as you can going in before. You never know what's going to happen in life. None of us have a crystal ball, but you can always look back in the past to see what did happen, and then therefore you can have a reasonable expectation of what's going to happen. Here are your typical operating expenses. Property taxes. Two things to remember. This is the specific property taxes, and then also in Oakland, you're going to have something called business tax. City of Oakland likes to tax people. I don't know what they do with the money. And they're certainly not, they haven't built stadiums with it yet, or hired enough police, but that's neither here nor there, or hired enough services, but they like to tax. So in addition to your property tax, you're going to have City of Oakland business tax if you have more than 4, or really any rental units. You got to register your units with the City of Oakland, they slap you with a tax. So just understand when you go into the property, you got 2 types of taxes. Then you got insurance, property insurance, and sometimes it's recommended to have general liability insurance. General liability insurance helps you out with lawsuits. So does property insurance, but just an added layer of insurance. It's something you can get $1 million general liability a lot of times for $500. A good thing to have. Management, 2 things to remember: on-site and off-site management. If you have a building that's 16 units and above in the state of California, you must by law have an on-site property manager. Why is that? Anybody give me some feedback? Why would you want to? Why is it a law that you have to have a property manager on site, 16 units and above?
It's something happening every day.
Fire, shooting, it's, whatever. There's got to be a responsible party who's living at 3 in the morning when the fire breaks out to be responsible, to take control, call the fire department, whatever. Don't get caught without a on-site property manager. Can be very, if you're trying to save some bucks, you think you're trying to save some bucks, something happens, you could be in big time trouble. You have to have one. Therefore, you have to pay for them, right? They're also not free. So you have on-site and off-site property management. A firm is going to charge you for both. So you hire XYZ property management firm to manage your property. It's 16 doors and above. They're going to charge you for the cost of the on-site, which is going to vary, and then they're going to charge you their fee. And their fee is going to range anywhere from 5% to 10% of the gross rents they actually collect, depending on a bunch of things, how big the property is, neighborhood, so on and so forth. So just account for it. That's all I'm saying. It's not good or bad. It just understand that it's there and you need to budget for it. Maintenance. This is preventative and then emergency. There's always emergencies. Last month I have a fourplex and the guy's heater went out. So it went out and we had that big storm and we're in this big storm. It's cold and he hasn't got any heat. So he called me up and we figured it out. It's emergency stuff. That's a fourplex. I self-manage that. A lot of times people are discouraged about real estate because they don't want to be fixing toilets or responding to calls. So then just hire somebody. If you hire somebody, you just got to pay them. So understand that, all right? Utilities, gas, electric, water. What do we got in California right now?
Water
What does that mean for water prices? All right,
You still got a drought?
yeah.
I thought you had enough rain in December, that's all.
Well, I mean, we had a bunch of rain. I turned my sprinklers off. As soon as I turned my sprinklers off, it stopped raining. So all my grass is dead now. So, but that's all right. And then something else is sewer. It's a part of your water bill. So in Oakland is at least. Different areas might be billed separately. Repairs. This is your make-ready work. This is your, somebody calls you out. You got to fix a toilet. This is repairs. There's another line item. I won't get into it right now, but it's called capital expenditure. This is when you're making improvements to the property. That's not an operating expense. That's an improvement to the property. It's not on this line item, and I'll explain to you why that's important. Because that would take away from the net operating income. It would take away from the value. So if you install a water heater, that's not a repair, that's a capital improvement. Okay, if you put a bunch of windows into the property, new windows, it's not a repair, even though if somebody broke a window, it kind of is a repair, but actually that's a capital improvement. You're improving the quality of the building versus, so that it's categorized differently. Holly? I have a fourplex I just was telling you guys about. I pay all the garbage, right? But that building is individually metered for water. They pay all the water. Now that's on that building in particular. From a legal standpoint, that's a good question. I don't know. A lot of times, because if the building is master metered for water, meaning that there's only one meter, right, for the water, and there's 4 or 5 different units, it's going to be almost impossible to figure that out, who's using how much. For gas and electric, there are systems that they can put in place to be able to figure out usage, and you can build that back for sure.
Because what I do is for my building, I take the whatever the bill is and divide it between every single tenant there.
Right.
But
Yeah.
that's just,
Well, I mean, that's the mathematical way to do it, right? But then what if, so it gets sticky if some guy says, well, I'm only here, I leave the house at 7 in the morning, I get back at 7 at night, I don't have any kids, my neighbor's got 4 kids, he's at home all day, they're using more water than me, you know what I mean? So they could bring that up, but I mean, legally, that's why I don't know. But I mean, that if you wanted to build them back mathematically, that'd be the way to do it.
they don't.
One more thing to look at before we move on. Reserves, budget for them, right? Stuff happens. So just put a certain amount of money away each month if you can, if you're able to, right? If you're not able to, do what you can do. But when you're evaluating a property, you want to put that in your numbers so that you're prepared for it, all right? So when you total up all these numbers, that's the total operating expenses. Now, you take that away from the effective gross income. And that's going to bring you to the lifeblood of what this business is about. That's going to bring you to what's called the net operating income, right? The net operating income is what's left over after you've collected all your rents and your other income and you've paid out all your operating expenses, but you haven't paid your mortgage yet, right? Key, a mortgage is not an operating expense. It's what's called debt service. You're servicing the debt. If you paid cash for this building and you had no mortgage, you're still gonna have property taxes, you're still gonna have insurance, you're still gonna have all the stuff we just talked about, right? So the net operating income is basically what's left after you collect the rents and pay your bills, but before you pay your mortgage. This is the value of the property. Because why is this the value of the property? This is the money you have to pay your mortgage with, and this is the money you have to pay yourself with. Make sure you're planning on paying yourself because the business is tough. The economy is tough. Stuff happens. You have to plan on paying yourself. If you don't plan on making money, you're going to lose money 9 times out of 10. Unless you're just really lucky, right? So this is why, though, it's specifically the value. I mean, what I just was telling you, that's why it's valuable. That's why it's the value of the building. But here's why actually it's the value of the building. So when an appraiser comes to appraise your, income property, this also goes for any other type of commercial income property, they're going to capitalize the income, right? And that's how they come up with a value. And they're capitalizing the net operating income, not the gross income, the net operating income. There's some other factors like gross rent multiplier. I try not to look at the gross rent multiplier a lot. Here's why. Gross rent multiplier does not take into account operating expenses. And operating expenses can vary wildly. So I always look at the net operating income and utilize the capitalization rate to get to the value, because that's how appraisers are going to look at it. So what is cap rate? Well, capitalization rate, is known as cap rate. So if you hear somebody say cap rate, that means capitalization rate. What is it? Essentially, it's the rate of return generated by a real estate investment property based on the annual net operating income, the annual NOI that the property generates. Basically, in layman's terms, it represents the percentage return you would get from a building if you paid cash and didn't have a mortgage payment. All right? Here's an example of that. Say I went out and I had a boatload of cash, I won the lottery, or I just signed a big contract, whatever. I got a bunch of money. I went out and bought a building for $1 million. So that price is $1 million. That building generates a $100,000 net operating income. What's the net operating income? It's what's left over after you collect your rents and your other income and you pay out all your operating expenses, right? So remember, I don't have a mortgage on the property. So how much money a year do I put in my pocket? Wild guess. 100 grand. That's my net operating income. I got no mortgage, right? I paid cash for it. Paid all my bills. I generated I took in all my rents, paid out all my bills. 100 grand was left over. That's my NOI. I paid $1 million for the building. That represents a 10% cap rate, 10% capitalization rate, right? Because 100 grand is what percentage of $1 million? 10%, right? It's simple math, right? 10% of $1 million is 10% cap rate. Now, these numbers are inversely related. I don't want to go too deep into math. I don't want to bore anybody, right? But the numbers are inversely related. So that means if I have two of these numbers, cap rate, NOI, price and or value, I can come up with the other number. So just know that. So in other words, I can get my cap rate by knowing here's the NOI, here's the price I have to pay or I'm going to pay. That equals my cap rate. If I have NOI and cap rate, what can I do? Well, I take my NOI, divide it by 10%, 0.1. That's going to give me what? Purchase price and value. So they're inversely related. If you got two, you can figure out the other one.
Your rule of thumb, return on investment or capital, what is the number for you?
Great question, man. Great question. And here's the deal. It's going to vary. It's going to vary on city to city. It's going to vary on neighborhood to neighborhood. And then it's going to vary market conditions. Right now, if I find an 8% cap rate in East Oakland, I'm doing great because the average is probably about 7.5. A couple years ago, I'm finding 9 and 10% cap rates all day long. So understand this, a cap rate is the higher the better when you buy, because that means a higher rate of return. When you sell, the lower the better, because now, basically, you're in a better market condition. You want to sell in a better market condition, right? And you want to buy ideally when things are softer. So right now, I like to deal in a lot of neighborhoods like East Oakland because it's. Well, I wouldn't call it a distressed neighborhood. I would like to call it a lower to moderate income. I certainly wouldn't call it distressed. I'd say lower to moderate income. Why? Because there's more people like that. There's more people out there. There's more people making less money than there is making a lot of money. You talked about the rich and the poor. How many poor people versus how many rich people are there, right? So who makes more money, Walmart or Scott's? You know what I mean? Or Walmart or Neiman Marcus. That's probably a better comparison, right? Who makes more money? All right. So That's my philosophy. There's a lot of people who stick only to high-end neighborhoods, San Francisco or by the lake, and they make a ton of money too. Everybody's got their thing. But I like neighborhoods like East Oakland, where there's more people, it's a little bit simpler, and then I'm familiar with that. So if I can find anything 7.5 and above, I'm doing great right now. If I was to say, hey, I want to go into San Francisco, I think if I'm finding any 3.5% and above, I'm hitting a home run. You know what I mean? No, really, seriously. I think if I'm out in Stockton, Sacramento, I want to try to be 8.5, 9. Although those are becoming harder to find too. So it just depends on the market. It depends on where you are, and then also what your goals are. Therefore, don't be afraid of out of state. When I first started, my first deal was in Pueblo, Colorado, 2003. It was my first ever real estate deal, right? And I was here in California. At that time, out-of-state investing was real popular. When the market crashed, it only made sense for people to stay local because the prices were cheaper than really they hadn't been in a long time. So if you're saying, based on your plan that you set up and said, this is what I want to achieve in my investment life, I need higher cash flow, then that may mean you may have to leave out of the Bay Area. Doesn't mean you have to, but that just depends on your plan and maybe your lifestyle. Maybe you travel a lot already, and maybe that's easy to do, or maybe you got 3 or 4 kids and you don't travel, so you can't do that. So that's why having a plan specific to your life is important, because that's going to dictate, you know, what cap rate you're looking for, what areas you're looking for, so on and so forth. That make sense? But I would say here in the Bay, well, here in Oakland, 7.5% in East Oakland, West Oakland. If you're downtown Oakland, you're looking at 5.5, 6. If you're by the lake, 4.5, 5. If you're in San Francisco, if you're doing anything above 3.5 is outstanding. Stockton, Sacramento, I'm looking for 8+, right?
That's all multifamily.
Yeah, multifamily. When you go into, you know, retail, it's different. Office is different. Office cap rates are higher. Retail depends. Just a little segue, so you asked that. Retail property kind of depends on the tenant. So this is, we're in a retail property, right? So my tenant in the front's a beer place, great beer, but they're a startup. They're not a national tenant. This is their first operation. So if I were to sell this property, it's going to sell at a higher cap rate than if I had Starbucks in there, right? National company, million stores, you know, stock high, you know, reputable company. So when an investor comes in and says, hey, I'm buying into Starbucks, you know, they're willing to take, that's less risk, so they're willing to receive less of a return than if they're buying the Good Hot Bottle Shop, essentially, new company, single owner type of thing. So cap rates also depend, when it's in commercial, on who the tenant is as well, because you may be in the middle of nowhere, Kansas, but if you've got a Walmart or Starbucks, you might be looking at a 5% cap rate. You wouldn't, you know, you go down the street in that same middle of nowhere, Kansas, and find a 10% apartment building. But because you're buying Starbucks, you'd probably get 5 if you're lucky. Make sense? Okay. Other terms, and I'm going to go into something I think that's an exciting way to increase cash flow. Net cash flow. Now, this is a good one. Net cash flow is simply the cash remaining after all the expenses and the mortgage are paid. So this is the money you put in your pocket, right? This is the important money, right? You want to make sure that whatever building you're buying or evaluating has this. Now, here's another thing. If you're going to buy a single family home to live in, look at that house as if, hey, you got a job transfer and you got to move to New York or you got to move to Vegas. What would that house rent out for? The reason I say that is because that happens in life, right? Or you get laid off or something happens or you can't afford the house no more. Could you, for what you paid for that house, then rent it out for a positive cash flow? Or at least break even. Not saying don't buy the house, because I think I really believe in home ownership, the benefits of home ownership, tax advantages, long-term growth, having a home that you don't have to worry about the rent going up or somebody kicking you out. I really and truly believe that. But look at what, if you went out of business or you had to move across the country, what would you be able to rent that place out for, all right? Right now, rents are pretty robust. So even if you bought something in the Oakland Hills, you probably would be able to rent it out to cover itself and make some cash flow. So just another thing to consider. But as we're talking about investment property, as we're talking about apartments, that's the money you're going to put in your pocket, all right? Cash on cash return. That's the net cash flow divided by the total cash invested, which is the down payment plus closing costs, etc. Matthews mentioned it earlier. When you're looking at rate of return, you got to look at fees, right? So in your mutual fund or your stock portfolio, somebody's going to be charging fees, right? Usually, unless you're one of them online brokers that don't give you no advice, but it's free or whatever, there's usually fees. In real estate, there's fees too. Now, here's the thing. When you're buying, you're not paying a real estate commission in the usual situation. Use a realtor to help you find property if you're looking, all right? Because you're not paying that realtor to, you're not buying the house and then writing them a check for the fee, for their commission. You're buying the house, and then within the price of that house, your realtor is getting paid. But understand this, if you're getting a loan, there's going to be costs for those loans. There's going to be points on that loan. There's going to be junk fees, processing fees or whatever. There's also going to be closing costs, transfer tax. If you're in the city of Oakland, transfer tax is high. It's $15 per thousand. And you split that, what's the standard tradition is you split transfer tax buyer and seller. So that's a lot of money. And a lot of people miss that. So your cash on cash return is not just considering your down payment, but it's considering your down payment plus all the closing costs. Key thing to remember, a lot of people miss that. So we call your down payment plus your closing costs, we call that the initial investment, all right? And so cash on cash return is the net cash flow divided by the initial investment. Yeah?
How do you justify your initial investment as far as, let's talk about percentages, right?
Yeah.
You put 20% down, you put 5% down, your payment doesn't fluctuate very much.
Yeah. Well, that's a really good question, and I'm also going to go into that on the next slide. But as a general rule of thumb, two things: you want to preserve as much money as you possibly can. I mean, if you can avoid putting 50 to 100% down on the property paying cash, utilize leverage. Yeah. No, but what I'm saying is this: as a general rule of thumb, less is better. However, you don't want to over leverage the property, meaning that you don't want to have so much debt that the property don't cash flow, right? So you want to, and that's really a factor of the operations of the property. So when you're going to go get a loan, they're going to probably require you to put 30 to 40% down.
That's my question. Why? Let's take your $1 million example.
Right.
$1 million, let's say we were 20% down, so now we have $800,000.
Right.
At $800,000, let's say it breaks even. Versus somebody else gets that property, they get $50,000 down, but they lose $100,000.
Right.
I'd rather personally have that extra $150,000 in my pocket and take $100 loss than to give the bank that additional $150,000 for another 30 years. And I can take that money and do something else with it and generate income and hope that my property appreciates.
Come on.
Versus giving the money to the bank just to be worried about paying my.
And it's a good thought, but that's what got so many people in the foreclosure. So many people in the foreclosure. Because, first of all, understand this, when you're putting a down payment, it ain't going to the bank unless you're buying an REO. It's going to go to the seller. The bank is only going to give you so much leverage because they want you to have skin in the game. They want you to say, hey, look, if this goes upside down, you're not just going to walk on this because you got 20 to 30% down in it, right? You got something in it, right? Now, the reason why you don't want to do that is because what happens if the market shifts tomorrow? And now, not only are you losing money every month, now your property is not worth it. You know what I'm saying? Now the property's shot down and you can't get out of it. And now that you can't get out of it, you can't sell it, you're losing money every month, so why would you continue to put money into it? You know what I mean?
All right, stay with us.
Yeah.
I'm missing. The price of the property is going to be the price when you purchase it. We can't justify the economy, right? It's going to be the same. So, $1 million house, go up 20%, you go down 20%. If it went down 20%, I'd like to have my $150,000 in the pocket.
That's a good point.
I mean, is that, am I saying the same thing as you are?
Well, I think here's the thing. Good point, but you got to understand also you have the debt service. You know what I mean? And that can eat you alive. And that's so understand. When we saw all these properties get foreclosed, it wasn't because the market went down in and of itself. It's because people couldn't make the payments. And then when you couldn't make the payments and the market went down, why fight to hold on? You know what I mean? The goal is cash flow because you don't know if that property is going to go up in value. It might. And this is a great conversation to have. It's a great conversation to have. You want to understand this because what else? And you got to look, where is that money going to go? Right, we talked about different investments. You said stock market's about 8% or Dow Jones 8%. Right. You might be able to take that money and start a company and make way more than you can make in the real estate market. Depends on your plan, right? That's why I say you got to have a plan, and whatever you buy has got to fit that plan, right? Now,
If you're getting a loan, it's the cost of doing business.
it's a cost of doing business, and also leverage can increase your rate of return, right? So if you get a loan that's cheaper than your cap rate, so say your cap rate's 8%, right? If you pay cash, you was making 8%, and your loan is 6%. Now you're making money on the bank's money. So you're making 12 to 13% on your money, right? So now you've got positive leverage. Negative, so your positive leverage is when you're making money, it's like arbitrage. You're making money on the bank's money, right? Which is what we want to do. That's what we want to do. Negative leverage is when you're losing money in the, on the bank's money. So you don't want negative leverage, you want positive leverage. So that makes sense. And then when you want to put something in the real, you want to put something down, but you also understand this. Let's say you only have 5% down, right? And then you want to go buy a property that requires 30% down. The bank may only give you a 70% loan, but you can go find partners, and you can go, or private investors, pay them a rate of return, and you only put 5% of your capital down, and then now you control that asset. As long as it cash flows, right? As long as you got that income coming in, it's a good investment. You know what I mean? The big thing to make sure you guys watch out for, and I just seen it because I saw a lot of people lose a lot of money with that, saying, hey, look, I just want to, I'm not tripping. I'm making money over here. I'll pay this mortgage. That's all right when it's, everything is rosy. When it goes bad, it's not all right. The good rule of thumb is to make sure the property cash flows. General rule of thumb. At what percentage that's going to be on you, right? You're going to say, I need to make 10% on my, if I'm going to buy this property, I got to make at least 10%. If I'm going to buy this property, I got to at least make 12. If you're going to buy real estate, you want to make sure you're making money. And I think you want to try from a cash-on-cash return, when we were talking about cash-on-cash return, you want to try to be double digit. That's like a good rule of thumb if you can get there. You know what I mean? 10% and above, right? When you look at real estate outperforms everything because of leverage. Because we're not paying usually cash for the property, we're getting a mortgage. And then that mortgage is going to, if we do it right, it's going to increase our rate of return. It's going to make the investment better if we play our cards right, right? One thing before I move on, internal rate of return. This is a calculation used mainly by institutions, but it's also important for us to understand because this cash-on-cash return is the most important way we get a yield in real estate, but it's not the only way. Every time you pay that mortgage, now you're paying it. If you have a traditional mortgage, you're paying it down. So you got principal pay down. You're getting some tax advantages from your interest write-off, and/or you're getting you might have a tax liability if you're making a ton of money, or you might have a tax benefit if you have a lot of depreciation on the property, right? Internal rate of return is going to look at the total return on the initial investment. So what you put in, and that's going to include cash flow. It's going to include principal pay down. It's going to include either a tax benefit or a tax liability. And it's going to look at what the appreciation is over the holding period. So this is something you look at typically over a period of time. I always use a 5-year holding period. You don't really know what's going to happen in the future, right? We don't know if they're going to go up. We don't know if they're going to go down. We don't know if it's going to go sideways. But we can calculate based on a net operating income what the property would be worth in 5 years. We look at our net operating income and capitalization rate.
How would you compare what you're putting today versus 06, 07?
Yeah. Things are being done based on fundamentals, and nothing's happening on funny money no more. The bank ain't gonna give you 90% leverage. The bank's not gonna give you 100% financing. It's real now. There's 30% of the transactions in California were cash. You know what I'm saying? And people making a lot of money. And I think it's based on, if you're gonna do it now, it's based on reality. It's also a lot more challenging. That's the flip side. You can't just walk in and breathe on a mirror and get a loan. They don't work like that, right? So I'm feeling a lot better than I was in 06 and 07 because in 06 and 07, while the market was rolling, it just didn't make sense. So you knew something was brewing. You know what I mean? You got a question?
Yeah, I was wondering if there's any other measurements used on total amount invested over the the cost of the building. So for instance, costs based on, capital improvements or interest paid,
Yeah.
things like that.
Well, there's a whole bunch of them. These are just like the basic fundamentals. As you own a property, you may have to put more cash into the property, right?
Yeah.
So, it all kind of depends. Now, I want to talk to you guys about return on investment versus return on equity. Two different things. And this is really more for once you own that property, now what, right? Because you buy one property, maybe that's not the only thing you want to do. Like the gentleman asked, hey, look, I want to, I don't want to just have my money in this property. I want to have it in other properties making money or other places making money. The goal is whatever you invest in, whether it's stocks, real estate, gold, oil, it should be making money from you, right? You take a risk, so you gotta evaluate that risk to see if this investment makes sense. So then these indicators are what we look at to be able to evaluate if this investment makes sense for us, right? So return on investment, ROI, that's really our cash on cash return, which I just explained. So how you get to your ROI, or cash on cash return, you take the net cash flow divided by your initial investment. So let's say, I bought a fourplex, for 400 grand, I put 100 grand down. And let's say annually I make 15 grand a year, right? So I take 15 grand and I divide it by 100 grand. And that gets me 15% cash on cash return. So that means I'm making 15% on my money, right? So I put the 100 grand down. And again, that's initial investment. That's down payment plus the closing costs, right? So I put that money down. Now I'm generating 15% cash on cash, right? That's my ROI. And I say here, ideally, you want to achieve double-digit cash on cash returns. It's kind of difficult to do in the Bay Area these days. All right? Not impossible, but it's difficult because it's competitive. You're now competing with people who can write a check for that building in almost every marketplace. And that's what we're dealing with. You know what I mean? And that's people come to me, well, how are these prices shooting up? Because people are paying cash. People are putting money in their self-directed IRA and saying, look, I'm scared of debt. I don't want any more debt. Although mortgages can be a good thing, right? But a lot of people are doing it. Also, we have a lot of foreign investors saying, hey, look, I'd like to have my money in America and I would like to not have debt. Let me just pay cash for this. Somewhere around 33% of the transactions in the whole state of California, and this is the most expensive state, maybe except for Hawaii, right? But in general, this is the most expensive state, were cash transactions. That's part of why the mortgage interest rates are so low, because they have to compete now, not just with other banks, but they got to compete with cash. So saying all that to say, you got to evaluate for yourself how much money your money needs to make, right? Nobody can tell you that. You can tell yourself that. That's going to dictate where you invest. If you can get 10% in the Bay Area, that's a home run. Most of the places in the country, you want to look at about 15% cash on cash. Internal rate of return, you want to be 25 to 30%. But just for cash on cash, 15%, okay? And here's just a rule of thumb type of thing. Your cash on cash needs to be higher than a going-in cap rate. So if I'm buying a going-in cap rate at 8% and I'm using any form of leverage, any form of a loan at all, right? I got to make sure my cash on cash is higher than my cap rate, or else what? The loan is negative leverage. It's costing me. It's not making me. So if I bought a property and it's an 8 cap rate, right, and I got a 5% interest rate, guess what I'm doing? I'm making money, because if I paid cash for the building, it's 8% yield, right? So the property is generating 8%. I'm paying the bank 5%. So my cash on cash return is probably going to be 13, 14%. I'm making money on the bank's money. That's what you want to do. You don't want to lose money on the bank's money, because it's risky, General rule of thumb. Now, that's when you bought the property. Now, let's say you bought a property in 2011. What's happened since, right? It's probably come up in value 50 to 70%. Maybe there's a couple people I know who have doubled their values since they purchased in 2010, 2011. Bottom line is now they have a ton of equity, right? So now figuring out, well, what do I do? Do I hold on my property, just keep paying it down, pay it off, and own it free and clear in 10, 20 years or whatever, right? Or do maybe I sell and buy something else? That's a big thing right now that a lot of people are asking. And we're starting to see a lot more transactions because of that, which is great. We want to see more of that because we need more inventory. Right now there's a shortage of inventory. So people are asking, well, what do I do? Okay, well, what you want to do is you want to look at your return on your equity as it relates to your return on your investment. So here's just an example here. Say that same property you bought, the fourplex we talked about, you bought it for 400 grand, you put 100 grand down with the fees and everything. Now it's grown in value. Let's say now it's worth 600 grand. So your 100,000 you put down has turned into 300 grand in equity, right? That's part of why you want to invest in real estate, by the way, because cash flow is one part of the return. That's a nice pop, ain't it? And that's happening right now. So now you got to figure out, what am I going to do with it? Now, that 15 grand a year that you're making, well, while on the 100 grand you put down, you're making 15%, but how much are you making on your equity? You got 300 grand in equity. What's your return on your equity? It's 5%. So you take your 15 grand divided by 300 grand. Well, your equity is only yielding you 5%. Your cash is yielding you 15%. So that's a home run, but your equity is only yielding you 5%. So now, this is an important consideration, because what do you do? And what do you do goes back to, what is your plan? That's why I keep saying investing is a plan. It's going to be different for everybody else. If you're maybe at retirement, if you're at retirement age, it might be time just to hold on to this property, pay it down, pay it down, pay it down. If you're trying to build wealth, right? If you're trying to come up, if you're trying to get to that point, maybe it's time to sell and do a 1031 exchange. Because here's why. Let me just show you how you can double your cash flow in one move. Now, and just understand this about return on equity. It diminishes as the property appreciates in value. I don't know what happened to the E, but it should have been in there. But it diminishes as the property appreciates in value. That's a good thing, though. It's okay. It's all right. You want your property to come up. But as your equity grows, your return on that equity diminishes. So just understand that. Meaning that the opportunity cost, that you can take that equity now and roll that over and do something else. For example's sake, let's say everything stayed flat, and you took the 15 grand you're making divided by your equity. That's only 5%, like we just said. So here's how you can accelerate your cash flow, if you want to. Now again, it might be in your best interest, just hold on to it and pay that mortgage off till you got it paid free and clear. But if you're looking at maybe doing some other things and growing and accelerating your cash flow, let's just say you sold that property. What about taxes? Matthew, what about taxes? Greatest killer of wealth, right?
Exactly.
Well, in real estate, another great reason why you should invest in real estate, like you asked about cap rate, what's the rule of thumb? A couple years ago, you can find 9, 10% all day long. It's hard to find that now because the market improved. So my cash on cash return may not be 15%. Let's say on this example, my cash on cash return is only 10%. So when I made this move, I actually came down in percentage, right? My percentage came from 15% to 10%. But what happened to the actual money I put in my pocket? 30 grand a year now at 10% on 300 grand. The result, that you doubled your cash flow. I was making 15 grand before, right? That same property, that same 100 I put in, property value grew. I sold the building. I deferred the taxes. I didn't avoid them. That's an important word. I deferred them. That's what a 1031 tax exchange is. And on one of our upcoming seminars, I'm going to have a 1031 exchange guy here, and we'll go through that. But just know that you deferred the capital gain, so you paid zero capital gain. That's why real estate's a great investment. And you took that 300 grand and rolled it in. And even though you weren't getting the 15% you were getting before, you took a hit in terms of percentage, you doubled your cash flow. You went from 15 grand a year to 30 grand a year with the same initial investment you put in, right? That's how you can grow your wealth. That's how you can increase your cash flow and accelerate your cash flow, right? That's just one example. I've got a client who sold 2 houses they bought in 2009. They just bought a 52-unit apartment building in Stockton for $2.2 million, right? And they financed those houses. They put about 50 grand into those houses. They sold out and they came out with about 300 grand, right? They put that in this apartment, and now they got about, $500,000 of equity. Started with 2 houses, sold them. They got 2 houses, got them a 52-unit apartment building, right? Same equity investment. 4 years later, that's where they're at right now. So that's just an example of how you can accelerate your cash flow with the same money you put in, right? So, market conditions change because people. The biggest thing my clients say now, I want to buy more, but I don't want to sell what I got because what am I going to buy, right? I can't get my 15% before. But they didn't look at this, you know? If you looked at it like this way, hey, maybe my percentage is less, but what is the net number to me? If you could double your cash flow, even though you're making less of a percentage, you know, why not? The why not is up to you. It's up to what you're doing. It's up to your plan. And that's what you use a financial planner for. That's what you use a CPA for. That's what you use a broker for. That's what you spend time on the internet. That's what you spend time coming to these seminars for. And then you develop that plan and then you go forward and act accordingly, right? The thing to know about real estate is it's not a get quick or rich scheme. There are people who have hit it rich quickly, right? But that's the exception. It's not the rule. So just develop a plan, stay focused to the plan. Be the hedgehog, not the fox. Be singularly focused in on some fundamental principles that work for you, that you're focused on, and then you'll have a much better chance to succeed.